Okay, have we started?
Well, it says we're live, so I don't see any panelists. I don't see.
Oh, there we are. Okay, so we're starting now. So welcome, everyone. This is the February version of our monthly webinar series. And this month, because it's tax planning, it's coming into tax season, we thought, let's have a tax planning presentation. Everyone loves talking about taxes. No one likes paying it. So that's what we've done today. And the topic for today is tax planning strategies that actually work. And just a bit of an introduction about us at West End Wealth Planning. Many of you are likely familiar with us. For those who aren't, we work specifically with business owners, professionals, and successful people who are serious about planning. These people generally want to do the same things. They want to create either a work optional lifestyle for themselves. If they're retired, a worry-free retirement where they're not worried about running out of money and leaving a lasting legacy. Now, to do that, we've developed a unique program. And that program is designed to put all the pieces of a client's financial puzzle into one place. So they always know where they are and they always know where they're going. And we call this the guidepost formula. And really, it's a holistic approach, which we don't feel, as far as I'm concerned, it's the only way you can properly manage people's financial situations successfully. Now, I'm very pleased today to have my associate advisor, Akiva Ames, with me. Akiva has 18 years experience in the financial planning industry, wealth planning. Akiva loves talking about financial planning, and he's came to us several years ago after spending a number of time with some major financial institutions. Now, we want to be very respectful of your time today. Again, we will end this presentation no later than 2 p.m. Excuse me. We'll probably speak for about 45 minutes about question and answer. Now, if you have questions during this presentation, by all means, if you go to the bottom of your screen, there's a little box there that says Q&A. You can ask questions on the bottom of the screen, and we will leave a place at the end of the presentation. We'll do our best to get to them. Can't guarantee we'll get to everyone, but please feel free to ask your questions. If we don't get to your question, you're welcome to go to ask us by simply going to info@westendwealth.com, info@westendwealth.com, and we'll do our very best to get back to you. And by the way, today's presentation is being recorded and will be available on our website, westendwealth.com. Now, when we first started planning this presentation, quite honestly, there's so many tax issues we can talk about. We could talk all afternoon, couldn't we, Akiva?
Yeah, sure.
So what we want to do is try and focus and talk briefly. We can't go into detail about many of these because there's no time. And the thing that you want to be aware of is every strategy we're going to talk about works, but it doesn't work for everyone. A great strategy for a couple A, B, or person A is the wrong strategy for person B, and vice versa. That's where the planning, the long-term big planning, comes into play. You really need to look at the big picture, both now and down the road. Make sure all of your financial puzzles are taken into account before you implement any strategy. You always want to make sure you're dealing with an experienced professional who knows about tax planning, who has your tax returns, and only if they have their tax returns can they really make assessments for you. Let's see now. By the way, this is only for tax planning items for individuals. We're not talking about corporations. Now, if you are a corporate investor, if you have a corporation, if you have a business, we're having a presentation next month for you. We're going to be talking about creating tax efficient passive income within a corporate structure. A very, again, misunderstood topic, a lot of intricacies involved. We're very pleased to have Frank DiPietro joining us. Frank is Vice President of Estate and Tax Planning at McKinsey Investments. We work extensively with them. They are extremely smart in this area. So again, that will be March 17th. That's a Wednesday at 1 p.m. So let's get started.
So Paul, there's some basic misconceptions a lot of people have about tax planning, and that can inadvertently lead to maybe some very expensive mistakes, can't it?
Well, that's it. What I find is that there's a number of areas where we see people come to our office and they're really not thinking about things accurately. For example, the first thing is the difference between marginal and average tax. People come and say, oh, I'm paying about 25% on my tax. And we look at their tax return, they go, no, you're in the 45% marginal tax bracket. And the marginal bracket is the only one that's important. The marginal bracket tells you how much extra tax you'll pay for $1 of extra income, or how much you'll save if you're able to reduce your taxable income. So again, marginal tax bracket is the only important number. The other thing really, Kiva, the difference between tax planning and tax preparation. Again, we find this, people come into our practice, and many of you are aware we spent over 20 years on radio, and we had literally thousands of people come into our office. And what we find is that people say things like, oh, I have an accountant. Great, you have an accountant. Accountants are great. They do a lot of great things. But for the most part, what your accountant does is put history on paper. In other words, there's what happened last year. We're going to put it on paper. We're going to make sure you get all the credits and debits that you're entitled to, but it's old news. Tax planning, on the other hand, is, okay, let's look at your entire financial situation. Let's look at your investments. Let's look at your tax situation. Let's look at your estate. Let's look at what type of income you may need and when. How can we structure your situation now to save you money, not only this year, but maybe 5 years down the road, and 10 years, or in your estate? And by the way, this is the big stuff. People often spend time trying to earn an extra 0.5% on their portfolio, and that's important. But quite honestly, often that's pocket change compared to saving money on taxes when you're planning for the long term. So that's another thing that people misconstrue. The other thing, simple things, focusing on a pre-tax dollar. A pre-tax dollar to me doesn't mean much. The only important dollar is an after-tax dollar. So for example, when we look at a strategy, we look and say, okay, never mind now, how much more will this provide to someone after tax, either for retirement income or in their estate? Again, an after-tax dollar is the only important dollar. And the last thing, just simply understanding the different rates when you're dealing with investments, clearly understanding that interest income and net rental income are taxed at your highest marginal rate. Dividend income and capital gains are taxed differently. And by the way, sometimes dividend income, if you're in a lower tax bracket, it's the best income you can get because you may pay nothing on it. But as you have higher taxable income, over about $95,000, capital gains starts to become cheaper. So again, that brings in the aspect that planning is the key to saving taxes.
And that's a really good point, Paul. We often find ourselves working hand in hand with a lot of our clients' accountants to make sure that we have their tax planning done properly. So when the accountant does the tax history transcription, it's to the client's best advantage.
Good point, Akiva. The secret is to have the team working for you. That works. That makes good sense.
We've also found clients coming in and they'll make a comment like, I don't do RSPs because at some point in time, I'm going to have to pay tax on the money anyway. Does that make any sense?
Well, that's a great point. Matter of fact, I was speaking to a business owner yesterday. This lady, she's a distributor, manufacturer, and she said she's 50 years old, by the way. She says, well, really, we don't have any money in RSPs. Me and my husband, we focus on other things. She says, someone told me it's not a good idea. I go, really? Because I've done the math on it. And the math tells me that your statement is wrong. See, here's what people don't consider. And by the way, it's not, as I mentioned before, it's planning. There are certain circumstances when an RSP is not the best investment. However, for the great majority of situations, it is. And it's so simple to prove. People compare investing $1 into an RSP versus $1 somewhere else, but that's completely wrong. If you compare investing $1 into an RSP, assuming a 50% tax bracket, you have to compare that to investing 50 cents somewhere else, because you get 50 cents back on your RSP investment. If you compare $1 and $1, it's completely wrong. Now think of that, investing $1 up front versus 50 cents. Who's got the huge advantage moving forward, even if one is more taxable at the end of the day? The other thing about RSPs is the tax deferred growth. Now this is way more important than most people realize. I mean, I think Albert Einstein was purported to have said that compound interest or compound growth is the eighth wonder of the world. And people don't realize if you have investments growing that are taxable, that chips away every year at what you have. And people kind of disregard that. It costs $1,000 a year, whatever, paying tax, or $5,000, and then in your state and so forth. So again, between the upfront tax, huge tax advantage, and the tax-free deferral, if you do a proper comparison, you're way ahead with the RSP. Now, when it's not appropriate, for example, if you're in a tax bracket, a modest tax bracket now, lower tax bracket, and you might even be in a higher tax bracket when you retire, well, that's probably not a good place to put money in your RSP. Even if you're in a low tax bracket now and you expect your income to be low during retirement, it may not be a good thing to do to put money into your RSP. By the way, next week when we talk about business owners, we're going to also talk about, for business owners, a very good alternative to an RSP, which allows a much greater tax advantage, but you got to wait till next month to hear about that.
Paul, you also mentioned before, the thinking a little bit has changed as to what investments go into a registered plan versus a non-registered plan.
Yeah, good point, Akiva. In, let's say 20 years ago, 10, 20 years ago, you could go out and buy a GIC and earn, I don't know, 5, 6, 7%. So because interest income from the GIC is fully taxable at your highest marginal rate, which we already talked about, you generally want to put that into an RSP or a tax-free savings account today, because it's sheltered from growth. And then you'd keep your equity or more tax-efficient investments outside, because dividends and capital gains, you're going to pay substantially less tax than interest income or net rental income. But things have changed now. You can't earn 6, 7% on a GIC or a bond, whatever. You're earning 0.5% or whatever. You're earning peanuts. So to utilize a tax-efficient investment like an RSP or a tax-free savings account, you're not saving much. And oftentimes now, it's, again, every situation is different. Are you a very conservative investor, or are you a more growth-oriented investor? This is where the planning comes in. Always, always, always the planning. It may make sense now to put your more growth-oriented investments inside a registered plan. I mean, we've seen a lot of explosive growth in the last year or two with high tech and so forth. Those may be more suitable for inside a registered plan. And if you want to keep, here's a situation we often see, right, Akiva. We have, especially folks closing in on retirement or in retirement, they want to keep a sizable cash. They want to keep cash, and it could be $50,000, $100,000. We've seen even more, right? Mm-hmm. And they'll have that inside, say, a tax-free savings account. You're wasting the tax-free savings account. You're earning nothing on that, or next to nothing. You're saving next to nothing. Have that cash outside. It's only going to attract a small amount of tax because you're earning next to nothing on it. So that's a mistake that we see. It's not uncommon today to see that. So again, the change today is you might want to consider holding your growth investments inside your registered plans, and your less growth, your interest bearing outside. That's the change that you might want to consider today.
And again, every situation is individual. So that's why as Paul said, every situation has to be looked at individually. Regarding owning other properties, I had a client yesterday that I was talking to who the parents had purchased a property years ago, probably for $80,000, worth well over $1 million now. And they were saying, there's lots of children, there's grandchildren. Can they do something to transfer it maybe at below market, so as not to have a big tax bill when the parent passes? What's your opinion on that?
It's a good point, of course, because generally cottage properties and vacation properties have skyrocketed in value over the last while. By the way, I just want to mention again, those of you who are interested to ask a question, just go to the bottom. There's a place that it says question, Q&A. We are allocating a time at the end of the presentation. We're going to do our best to answer your Q&A questions, but feel free to put them in now. Also make note that, again, this presentation is being recorded and will be available on our website, westendwealth.com, westendwealth.com. Now, it's not going to be there immediately this afternoon. It'll take several days before the people that do that manage to arrange it. So just be aware of that. And again, don't be hesitant to ask us a question. But that's a great, glad you brought that up, Akiva. You know, it's not uncommon. You have parents have a cottage, maybe it's worth $1 million. And maybe they bought it for $200,000 or $100,000. So there's a big unrealized capital gain. Well, they're saying, you know, geez, you know, the kids are adults now, they have their own kids. Maybe we should just transfer it over to them now and let it be, let it stay in the family. Of course, we know if you're to transfer today, you transfer ownership, that triggers all of the unrealized capital gain. So it's not uncommon if people say, geez, you know, it's worth $1 million, but let's just say it's worth $750,000. Let's save tax on that extra $250,000. But that can create a problem a number of ways. But the main problem is if old RevCan, if CRA gets wind of that and they're looking into these things much more closely now, you could not only have to pay back the tax that you saved, you might have to pay it twice. There's a doubling of the tax on that. So you don't want to get involved in that. Now, there are alternatives, by the way, to doing this. Some of the great alternatives, you can look at capital gains insurance. Capital gains insurance is one of the cheapest ways to pay the capital gains tax that has to be paid one way or the other. That's a strategy. You can look at things like trusts. Again, you want to be aware when you're transferring ownership, and this is more of an estate planning issue, when you're transferring ownership to children, if you have more than one children, you really want to be careful to equalize the estate. It's, again, we're getting off tax planning here a bit, but of course, you may have two kids. One really loves the cottage, they're cottage people, and the other one, so-so. So we'll leave it to one child, but not the other. Well, you want to make sure you equalize your estate there. And it's something that needs monitoring on a regular basis. But this is not an estate planning presentation. So we'll get back to the—
Give you an idea for a successive one. Yeah.
Well, yeah, but again, don't try it. And if you, now, of course, you want to get a valuation of your cottage that's on the low end, but it's got to be a real valuation. Don't try to cheat the tax man.
Yeah. Yeah, I guess we're getting a little off topic. It's also important to track any renovations you do and capital upgrades, but we're getting a little bit off stream there.
Good point, Akiva. Yeah. So if you add an addition or you renovate your kitchen or whatever, that's a capital upgrade. So let's say, to go back to our example before, you have $1 million cottage you purchased decades ago for $200,000, but you put in maybe $200,000 worth of improvements, maybe an addition, this, that. Well, now your cost base is $400,000. So the tax would be owing on the difference between the $1 million value and $400,000, not $1 million and $200,000. Great point, Akiva. Thanks for bringing that up.
And it's a tax savings point, so we're not too far off topic.
Yeah.
But back onto more mainstream tax saving things. There is an idea that might not be open for much longer. Regarding income splitting between two spouses. Do you want to expound on that a little bit?
Oh, yeah. We talked about this in the invitation for people. And this is an income splitting opportunity that is available now, and there's a bit of a window on it. In other words, it will continue to be available in the future, but it may not be as advantageous. So let's set up the scenario here, Akiva. We have, let's say, two individuals, husband and wife, let's say, and one individual has, through whatever means, has a large non-registered portfolio. Maybe they inherited money, maybe they received bonuses from their company, whatever, it doesn't matter. They have a large unregistered portfolio that's in their name and it's taxed all in their name. And let's say that person is taxed at 50%. Their marginal tax bracket is 50%. Let's say they have $1 million that's taxed at 50%. In other words, all the interest, capital gains, dividends is all taxed at 50% in their name. And their spouse is in a much lower tax bracket, maybe 20%. So now the problem being is you got, how can you income split with that? And there's a way to do it that's completely legitimate and easy right now. The higher income spouse with the $1 million portfolio can loan that to the lower income spouse. Now, they need to do a small little agreement, but really just a few lines. Your wealth advisor can build that for you, very simple. And they sign a loan agreement. Now the portfolio is effectively owned by the lower income spouse, but they have to pay interest on it. Now, here's the kicker. Here's why this is so beneficial right now. That money is now taxed in the lower, any interest, dividends, realized capital gains is taxed in the lower spouse's tax bracket. But that lower income spouse has to pay loan interest to the higher income spouse. Now, right now, there's something called the prescribed rate. The prescribed rate is the government of Canada, CRA, tells us what the prescribed rate is. Right now, it's only 1%. And what that means is the lower income spouse has to pay 1% to the higher income spouse. So in our example, at $1 million portfolio, they have to pay about $10,000 a year. And that $10,000, the lower income spouse, they have to pay it, by the way. They have to issue a check. It has to be cashed. It's not a nominal. It has to be done. The lower income spouse will then take that $10,000 as a deduction and the higher income spouse as income. But the big difference is now that money, that $1 million, is taxed at probably 20% versus 50%. And that can stay indefinitely. There's no time limit on it. And down the road, as interest rates are likely to increase, and maybe the prescribed rate will go up to 2 or 3%, because you've set this up now at 1%, that 1% loan rate stays in perpetuity. It never has to change. It doesn't matter where interest rates go. So again, great tax saving opportunity. The thing is, you want to take advantage of that now. At some point down the future, I don't know when, likely interest rates will rise. That will precipitate a rising in the prescribed rate, which will make this less advantageous to individuals. But again, so spousal loan, very simple to do. We've done them for a number of our clients. Very simple to do, and real significant tax saving with no risk whatsoever. To me, that's the best way to do it.
You have a strategy also, Paul, where you mentioned asking a client, when will you spend your last $100,000? And that kind of touches on the estate planning you were mentioning earlier.
Well, that's true. Here's what we do, to let everyone know, those of you who are clients who may be listening know that virtually all of our clients have a long-range retirement and estate plan. In other words, we project down the road saying, okay, if you're not retired yet, how much income do you need during retirement on an after-tax basis? We look at all the sources of income, and we project this to the rest of your life. We project it to age 100. And what that tells us is a couple things. First thing, it tells us whether the person is in good shape to provide all the retirement income they need, but it also tells how much money they're going to leave in their estate. And oftentimes that number is a lot bigger than people realize. We've done these now where literally individuals are leaving $5-10 million in their estate 40, 50 years down the road. Now, quite honestly, the clients don't believe this. They don't believe the numbers, and they could kind of understand it. But nevertheless, it's often well into the 7 figures. So in other words, what we're saying by that is there's money that clients have now that they're never going to spend. They're virtually never going to spend this money, and it's in an environment where it's either taxed now. Let's say it's in a non-registered portfolio. You're paying tax on net rental income, you're paying tax on interest, you're paying tax on dividends, on realized capital gains every single year. And when you're 6 feet underground, you and your spouse, if you have one, again, any unrealized gain will be taxed. So it's taxed all the way along, plus taxed in your estate. If it's in registered money, like an RRSP, a RIF, it's all taxed in your estate, likely at 55% or more. So you've got all this money that you're not going to spend. And we may say, you know, when are you going to spend the last $100,000? So the secret is, what can you do with that money? Well, why don't we take some of that money that you're likely never to spend, and if you leave it where it is, it's going to be taxed almost every year or significantly in your state. Why don't we put it to some place that will never be taxed during the rest of your life and will never be taxed in your state? And that's called things like estate bond insurance. Now, of course, as soon as you say the word insurance, right? Sometimes some people go, oh, I don't want to give any money to the insurance company for whatever reason. But it really comes down to this. Insurance is one of the most tax efficient ways to use money with. Just ask the multi-million-dollar and billionaires who buy huge policies. And they buy them because of a very simple reason. They would rather give $1 to the insurance company than giving $2 to CRA. And it's that simple. You have money now, you can either give a bit of money every year to the insurance company or give it to CRA. And if you give it to CRA, you're going to give a lot more. And by the way, if you're a business owner and you have a corporation, maybe we'll talk about this in our next presentation on passive income within a corporate structure, which is on March 17th. The benefits are multiplied several times over. There are huge benefits to insurance within corporations, but the same benefits aren't open to individuals. Again, don't be afraid of the insurance company. The insurance company has many advantages that you don't. And if that's money you're not going to spend, why not leave more to your kids, more to your grandkids, more to a charity than leaving twice as much to CRA? I don't know about people listening, but I don't like giving money to CRA. And I'm guessing with all this government spending going on, or do you think tax rates are going to more go up, or do you think they're going to go down? Obviously, what do you think?
Good point.
Yeah.
Good point, Paul. I mean, obviously, the government's always looking to get a bigger handle on everybody's money. Regarding tax-free income, you mentioned insurance being very tax efficient, but even without going to insurance, there's some very good ways to create tax-free income from non-registered money as well, is there not?
Yeah, let's talk about that in a minute. First, I wanted to mention we're getting some good questions. Again, we're leaving some time at the end of the presentation. We're going to do our best to deal with the questions. Feel free to ask more. Just go to the Q&A box at the bottom of your screen. We're going to do our very best to get through as many as we can. Please don't hesitate. And again, we're going to remind you that this presentation is being taped, and it will be available on our website, westendwealth.com, westendwealth.com. By the way, you could just send us questions right to us. Simply to go to info@westendwealth.com, info@westendwealth.com. So we're talking now, tax-free income. I lost my train of thought there for a minute. So yeah, here's the big thing. I'm going to use an example, and it's a bit of an exaggerated example to make a point. Let's say you need $50,000 a year of retirement income after tax. Again, what did I say at the beginning? The only important dollar is an after-tax dollar. So let's say you could earn 5% in a GIC or a bond, which you can, but down the road, who knows? So if you had $1 million outside of your registered plans and you needed to create $50,000 of income, assuming a 50% tax bracket, just to keep things simple, you'd have to take out $100,000 from that to have half of it taxed away, to have your $50,000 after tax. Now, again, this is a simplified example. It's not right now, it probably wouldn't happen that way, but it's to make a point. So think of that. You're going to get your $50,000, but you have to take out $100,000 from your assets, of which, and that means that you have $100,000 less at the end of the year. Now, what if we could take $50,000 out of that million that's non-taxable? In other words, what if we could just draw out capital? And there's a way to do that. The mutual fund companies have what's called T-shares. And what they allow you to do is essentially, if you have, in our example, $1 million, and just assuming a 5% return, they will send you that 5% every year. And that is concerned all return of capital. Now, the neat thing about return of capital, there's no tax on it. It's already after tax money. So instead of having to draw out significantly more you only need to draw out $50,000 in our example to have your $50,000 after tax. Now think of that in the big picture. Because you're withdrawing much less out of your portfolio has much more in it. And it has much more in it. Now, the difference in what you would have paid in tax and kept, now that's still in your portfolio earning more growth. And next year, the same thing happens. And the year after that, the same thing happens. So it's mushrooming. So what this allows you to do is also keep your investment portfolio intact and growing at a much, much longer period. Again, these are T-shares. Similar things can be done through SWIP investments, systematic withdrawal plans. Again, there are creative ways. But again, this brings up the need for planning. Let me give you an example. For example, someone could call me tomorrow and say, Paul, I heard you on the presentation. Oh boy, I'm retiring tomorrow and I want to get this tax-free income. Great. We look at the portfolio and it's loaded up with investments that have huge capital, unrealized capital gains. Well, there's a perfect example of why we should have been doing planning 10 years ago for you. And a lot of people come to us and say, well, I'm retiring this year. It's a good time to start planning now. You know what? A good time to start planning was 20 years ago. Because in this example I just gave you, that person is going to get that tax-free income. They're going to have to create a big tax liability now to transfer investments that have a large unrealized capital gain. So this is a great example of the huge benefit of planning well ahead of time, looking at the big picture. And a good advisor, by the way, is going to ask for your tax returns every single year. They're going to ask for copies of all your insurance plans. They're going to ask copies for your wills and power of attorney. That's so they understand your situation totally and they can give you the best guidance. So there, again, plan ahead of time and you can plan for things like creating more tax efficient income during your retirement.
We often get the question from clients, when do I need to take money out of my RSP? And when can I contribute to my RSP? So we all know in the year you turn 71 is the year where you have to convert your RSP to a RIF. But is it possible to have an RSP contribution after age 72?
Well, not a contribution, but you can take a tax deduction.
Mm-hmm.
We've used this a few times with our client. Let's set this up. So what's happening today? People are working past 65. Lots of people work past 65. A lot of people work past 70 because we're healthier, we're living longer, and we just like working. I mean, it's not uncommon where people come to us and they go, well, if I don't work, what am I going to do? I like working. So here's the scenario. Someone is working, whether it's in their own business or for whomever, and they're earning a good income. They're 71. Normally this year, they're required to transfer their RSPs to a registered retirement income fund or RIF, and they still have to do that. But in that year, they're going to create more RRSP contribution room. But for the following year, they can't have an RRSP because they'll be age 72. But you can still take an RRSP tax deduction. So what you do is, in December of that year, which is the last month you're at age 71, it's the last month you can have an RRSP. You don't transfer your RRSP to a RIF until December. And just before that, you know that because you're working, you're going to be able to contribute, let's say $20,000 of RRSP the next year. You make that contribution in December just before you change your RRSP to a RIF. Now, you're going to incur a penalty because you're making over contribution. You're going to be taxed 1% of $18,000 because you're allowed a $2,000 over contribution. And in our example, you're going to have $18,000. So you're going to be incurring 1% of that for 1 month, which is about $180. Not too bad. But now next year, there's nothing that says you're going to create that $20,000 deduction. There's nothing wrong with taking that deduction next year, even though you don't have an RSP. Again, planning is key. You want to make sure that the following year, you're still going to have enough income where that deduction makes sense for you, because otherwise it may cost you. Again, you want to make sure you're going to get a good deduction and get a good rebate back from that.
Our webinar invitation said we would talk about 3 tax-efficient RSP withdrawal strategies. Did you want to touch upon that now?
Yeah, and just before again, want to remind people we're getting some questions in. That's great. Don't hesitate to go to the bottom of the screen to the Q&A screen and ask a question. We're going to leave a Q&A time at the end. We'll do our very best to answer what we can, or you can go to info@westendwealth.com. So yeah, there's a number of things that you can do, and here's a big one now. In your estate, the old way of doing things is, okay, I'm drawing money from my RIF. I'll draw the minimum amount because that's all I need. And a lot of times we have clients that don't even require the minimum amount of RIF payments, but you can't reduce that. So here's what you can do. Sometimes it makes sense to take out more, even though you don't need the money. You know, why would I take out more money from my RIF ball or my RSP before age 72? I don't need the money. Why would I pay tax on it? Well, again, it depends. And again, this brings up the need for big time planning, holistic planning, as we talk about, that takes everything into the equation. So, for example, in your estate, if you leave all that money from your RSP or RIF will like to be taxed at 55% or more, because all of this comes into your tax in your terminal return. Top rate marginal tax bracket today is about 53.5%, plus probate fees, another 1.5%, plus legal fees, plus whatever, 55% more. Well, what if you could bring that money out today at only 20%? That could mean a net overall savings for you. So again, this is what people often miss. You know, sometimes, and not all the time, this is where the planning needs to happen. It may make sense to take money out of an RSP earlier rather than later. And again, this can be from an RSP or a RIF. Can be it can make sense in either circumstances. But again, you want to make sure that you have a well strategized plan to do this. Just don't do it ad hocly, because it could cost you money. So what are some of the other things that we talked about? Well, here's another thing that you can do. We talked before about estate bond insurance. Well, let's say you're required to draw money out of your RSP or RIF, your RIF. You don't need it. You don't need it now. Well, again, that money will simply go into likely a taxable account. Now, if it goes in a tax-free savings account, that's better, much better. But if it can't be put in a tax-free savings account, it's going to be put in a non-registered account that's going to be taxed every year and taxed in your estate on unrealized gain. Take a look at the estate bond insurance we talked about. Again, sometimes it comes down, we can take this money and give $1 to the insurance company rather than giving $2 to CRA at the end of the day. And that's why wealthy people buy huge, huge policies designed specifically for this. All it means is it keeps more money on an after-tax basis in the family. And remember, Akiva, what's the only important dollar?
After-tax dollar.
You got it there. You got it. So what else do we talk about here? Well, sometimes
we
people
wanted to give it one hands-on experience that we've done in the past. Kind of touches on what you were saying before about why would I take income if I don't need it. And very often we'll have a case of where you have a couple, or maybe one spouse retires, they've both saved up a good amount of money, but one spouse is still working, and they have no need to draw on any of their money. So they might say, hey, why would I take RIF income now? And the thing is, if one of the spouses is in a zero tax bracket, making nothing, there's no reason not to use up some of that marginal room and start to draw on his RSPs. So that's kind of a hands-on experience of where the client's not actually spending the money they're drawing, they're saving it, but they're using up that marginal bracket to get out of a high tax.
You're talking about income splitting, because you can split your RIF income.
No, so not getting them yet. I'm just talking about creating where they're not income RIF splitting. I'm just talking about where the client, you may have one spouse who's still working, their salary is sufficient to take care of all the client expenses. The other client, the other spouse, maybe the husband or the wife, doesn't work right now but has a lot of registered money. That spouse may say, well, why should I draw on my RSPs? I don't need the money. But very often we tell them take that income anyway, $20,000, $30,000, $40,000 worth of income, just to kind of take advantage of their marginal low tax bracket.
Yeah, good point too. Also, again, remember when you're 65 or older, when you draw a RIF income, of course, you can split that from tax purposes. And that may make sense also to start drawing money out a bit early. But again, every situation is different, and you want to plan properly. A couple of other things, people make mistakes with RSPs. They put their investments in the wrong place. And what I'm referring to there are US and foreign dividend paying shares. You don't want to put them into an RSP. There's a 15% withholding tax on the dividends for US companies that in your RSP, because of the US-Canada tax treaty, it's not applicable. Great, best place for them. Outside in a non-registered account, you can, it's a W-8B form that you can sign to get the money back. But in a TFSA, you can't get the money back. So a TFSA is a place that you absolutely do not want to put dividend paying shares from US corporation. Now, dividend paying shares from Canadian corporation, very, very different. Again, you want to strategize that very, very differently. Here's another idea. People make a mistake with their RSPs. Let's set this up. So, married couple, one spouse earns most of the money, has funds. The lower income or one of the spouses wants to put money into an RSP, but they don't have the money. So the spouse with the money says, no problem, I'll give you the money. You have maybe 20, 30, 40, $50,000 of room. Here's 20, 30, 40, $50,000 of money. You put it into your RSP. Sounds like a simple solution. The only problem is you can get caught. And what do you get caught? There's something called the attribution rules. And if CRA realizes this, they're going to say, oh, well, that money now that was put into one spouse's RSP really was from the other spouse. Now, when the money is withdrawn from that RSP, the attribution rules rate may apply, and that may be taxed in the person's name who gave the other spouse the money. So again, you got to be careful. You're not really allowed to do this technically under the rules. You can't give your money to your spouse to make an RRSP contribution against the rules. Again, mentioned, we got some good questions. We're getting close to Q&A, but not quite there yet. If you have more questions, please feel free to go to the Q&A box at the bottom and ask your question. Couple more items, mistakes that people made. And again, I'm just looking at my checklist there. I want to make sure I don't miss some of these. With some people, oh boy, classic mistake. I'm going to take money out of my RSP because I got some debts to pay off. It's probably about one of the worst things you can do. I mean, why would you take money out of this plan that's growing tax-free for you, and you're going to pay a huge chunk of it up front in tax, maybe 20, 30, 40, 50%, when you can go to the bank and borrow money for nothing? The bank wants to give you money for virtually nothing today. So that almost never makes sense. Almost never makes sense.
And one point on that a person has to realize too is very often I've had this come in with clients where they'll tell me about a friend who, let's say, called the bank and they asked the bank, if I took 15,000 out of my RSP or 20,000, how much tax am I going to have to pay? And the bank is going to look at your schedule and say 30%, and that's fine. The client's happy. They get their 30% withheld on 20,000. They walk off with 14,000 and pay off their debt. Well, they get a nice little surprise at the end of the year when they get that 20,000 added to their marginal tax bracket, and they might be in a 40 to 50% tax bracket now and no additional money. And they come back and say, well, but the bank told me I only needed to pay 30%. And the answer is, well, at that time. But at the end of the year, there's the marginal bracket to worry about. So that's a point that I've seen before, hands-on experience that you have to be aware of.
Yeah, yeah. And of course, again, anything I want to remind people of, you don't want to, people probably listen to what we talked about today and they say, geez, that sounds interesting. Maybe I should be looking at that. Maybe I should be doing this or the other. Remember, you want to sit down with your advisor, a good qualified advisor who's very familiar with tax issues before you start implementing any of these strategies. And of course, your wealth advisor should be asking for your tax returns every single year. Without asking for your tax returns, the way I look at it, you can't properly do any tax planning. And here's why. I've had a few clients ask us, well, what do you need my tax returns for? What do you need? I can tell you what my income is. Yeah, but first thing, sometimes the information I get from clients may not actually be the right information. But also, it's what's the makeup of your income. For another, and this is especially true where people are getting income from various sources, from corporations, from different types of investment. It's taxed differently. Are you getting ineligible dividends from a corporation? Eligible dividend? Is it realized gains? All these things have a bearing on your planning, and that's why the advisor should always have your personal tax returns and ask for it every single year. So that's one thing I want to throw in. Akiva, you want to deal with some RRSP income? Is that right?
Just I saw a good question come across. If you're ready to deal with some of them,
Sure. Let's go now.
So one of the questions that I saw someone asked was, if you have a huge RSP, what strategy do you suggest to do so you don't get an old age security clawback? And really,
Yes.
I mean, if you want to take a gander at that, or I can, I mean.
Well, there's the planning. You may want to, first thing, delay taking money out of your old age security. And a lot of people don't realize this. You don't have to take old age security at age 65. You can delay it up to age 70. And if you don't need the money, sometimes that could be a big tax saving. So if you delay taking your old age security to age 70, you're going to get about 36% more old age security starting at age 70 than you would have at age 65. And remember, that's the base. That still goes up every year adjusted for inflation. That's really good, especially if you decide to take it early and you're taking and you have significant income. You may have that partially or completely clawed back. Again, this is where the planning comes in. You need to understand, you're a planner, and you need to understand how much after-tax income you need. What are the various sources of income? Does it make sense to take it from there, from here? You often have choices, and those choices can help reduce taxes on a yearly basis.
And just another point on what you're saying, Paul, in the interim, you have a client who's maybe retiring at 65, and maybe they came in with $500,000 of non-registered assets and $500,000 of registered assets. And they're okay with deferring their old age security. They don't really need that money right now. In the interim, they may want to start drawing down on the RRSP, start the RRSP early, so when they hit age 71 and they have to start taking the RRSP income, their RSP is smaller. Traditional old style thinking is, well, I'll just spend my non-registered assets till I hit 71, and then I'll start pulling on my RRSP income. Well, very often people wind up in old age security clawback territory. By kind of shifting things around, as you're saying, deferring the old age security, drawing income earlier, you may pay a little bit of tax on the RRSP income, 65 through 70, but at the end of the day,
good point.
At 70, have higher old age security income, less RRSP income, and globally, that's where the tax planning comes in. This is not the thing you can wake up at 71 and say, what can I do now? It's the type of thing you want to say, when I'm in my early 60s and I'm 65, what can I do so 5, 6, 7 years down the road, I keep more of my dollars versus CRA.
Exactly. Good point, Akiva. We have another question from, I believe it's Alfard. I apologize if I'm pronouncing that incorrectly. Asked a question about gross up income, gross up of dividend income for seniors who receive old age security. Great point. This is receiving dividend income from eligible dividends from Canadian controlled corporations. And because of the gross up, it actually if you're in the old age security clawback zone, which I believe is from about 78,000 to roughly around 120-ish thousand. If you're in that zone and you get dividend income, the gross up, it increases the clawback. Now you'll still pay a little bit less overall tax, but nevertheless, that's where you want to again, do your planning. Do I want to have more dividend income right now if it means I'm penalized with getting more of my old age security clawed back? That's a great question. Again, that's where the planning comes. I keep coming back to planning because I so firmly believe in this. We see people all the time depending on hope to make things right. Things will turn out right. Well, they don't turn out right unless you plan to have them turn out right and get great advice. So that was a good question. Thanks for asking that one. Who else do we have here? Should you have a balance? Should you have a balance? Here's a question here. One of our clients actually. Should you have a balance between registered RSP and unregistered investments? I think that means, Kevin, thanks for sending that in. I think that means, is there an amount ideally you should have between registered and non-registered? And not really. Again, everyone's situation is different. Whatever that balance is, how much do you need to draw out for the income you need? Are you just cutting it to the wire? In other words, you're going to need everything, or do you have well more than what you need? So again, it's not really a question that's answerable here, because 10 different people will, in the same situation, may have 10 different answers. So thanks for sending that in, Kevin. By the way, we still have time for a few more questions. Just go to the bottom and you can certainly, under the Q&A. Anita asks, what about a spousal RSP? Yeah, spousal RSPs, excuse me, are still valuable. They're not as valuable as they used to be. In the old days, I think about 10 years ago past, you could not split RIF income for tax purposes. And that made spousal RSPs hugely valuable. Now you can, but there's still some advantages to spousal RSPs. It allows you to split income prior to age 65. So there's still a good strategy, just not as important as they used to be. Can you see the question?
Yeah, I do. I see one. I see someone asked a question about building up a huge RSP, and I can throw in a bit of humor. We have some clients that call us up who may have a huge pension and a huge RSP, and they know they're going to lose their old age security in retirement. It's a given. You know, you've got 60, 70,000 of pension income. You've got $1 million in registered money. You're losing your old age security. You're not seeing a penny of it. There's nothing we can do. But I did tell the client you can get married. That's one thing you can do. If you can get married, you automatically
lower. That was just a few months ago.
Yeah. So that's one way to then you can split your income, and then you can maybe keep some of your old age security. So just a bit of
mind you, that may be a strategy. They'd rather pay more tax. You never know. Sometimes it happens. Sometimes it happens. Yeah, that's from Spencer. Thanks for sending that in, Spencer. Yeah, again, it really depends on your circumstances. Mm-hmm. You have a huge RSP. It may be like we talked about before. It may make sense to draw out some of that money early, and coordinating this with your old age security. Your spouse, how much income does your spouse going to have? How much can you transfer over there? There's a lot of questions that need to be answered there, which is why in a presentation like this, you really can't answer questions specifically, because again, 10 different people in the same situation may get 10 different answers. Because it's a part of it is based on Akiva. You've been in the business for a long time. I've been in a lot longer than you. I don't want to say how long I've been in this, but I'll be honest, I used to think that you could compartmentalize people and say, maybe there's 5 different types of people, but the older you do this, you realize that's absolutely wrong. You can have 10 different people or 10 different couples with very similar financial situations, but what's right for them may be all different. And part of it is what's in their mind. How did they grow up? What are their attitudes towards money? And those attitudes were often developed with how they grew up. Some people have a scarcity attitude. Some people have an abundance. Well, they deal with their money differently, and what's right to recommend to them may be different because of the way they think. So again, it is not a one solution fits all. There's no cookie cutter type answers, the way I see it anyway, with people with serious money. In terms of their planning. Maybe we have time for one more question here. Kiva, do you want to pick one?
I'm just going down. I don't know if I can see all of them here. Do you see one you want to answer offhand?
Oh, well, there's one here that says, what about alimony risk? That's from Lynn. I'm not going to alimony risk here, Lynn. I'm not going to talk about that. Here's some, when interest rates are so low, is it still a viable strategy to borrow from to move that into an RSP if you have cap? Well, yeah, it can make sense. The question is, does it make sense to still borrow money to put into an RSP? And again, because you're paying peanuts on the interest right now, and especially if you're getting close to retirement. So actually, this is Kevin. I know Kevin, he's a client of ours, and he's going to be retiring in the next little bit. Well, yeah, if you got unused RSP room, and maybe you can get 45% back. You want to get that money back now, because once you've retired and your marginal tax bracket drops to maybe 20 or 25%, whatever, you've lost it. So you're able to get right now free, no risk tax return. You absolutely want to take that. The government wants to give it to you. If you don't take it, shame on you. So that being said, we're going to start winding things up now. It's 1:55. We promised we'd have people out the door at 2 o'clock, and we want to stick with that. Excuse me. Remember, again, before implementing any of these strategies, you really need to speak to a qualified advisor who knows your situation, who has your tax return and understands the big picture. Don't start implementing strategies based on what I say or based on what you read in the media or anywhere, because there's a good chance they may not apply to you, and matter of fact, may be detrimental to you. Any of you who are listening who are not our clients and you'd like to speak with us, you got some questions, you want to see if maybe we can help you out, just send us a quick email at info@westendwealth.com. That's info@westendwealth.com. We want to remind everyone that our next presentation is geared towards the business owner. We are trying to do our monthly educational webinars, trying to alternate one towards a business owner, one towards an individual, and so forth. So the next month it's towards the business owner. And we're going to talk about an area that I find, again, is misunderstood, creating tax efficient passive income in your corporation. I know if you're a business owner, when you create passive income, you're taxed at 50.17% from $1. And again, I've got up here, info@westendwealth.com. Thank you for putting that up. So that will be our next presentation, and that is Wednesday, March 17th at 1 p.m. And we're very pleased to have Fred DiPietro, Senior Vice President of Tax and Estate Planning at Mackenzie Investments. These guys, we work with them extensively because they're darn good and they know their stuff very, very well. If you own a corporation, you absolutely do not want to miss that presentation. Oh, with that being said, I think we're getting close to the end of the day. I want to thank everyone for joining us. I hope everyone is staying safe out there. Thank you for joining us during these challenging times for us. But the good news is things are getting better. And I don't know if you read today, COVID, the number of new cases, deaths is dropping like a stone, even in the US, surprisingly. And there is light at the end of the tunnel. And hopefully maybe this summer we'll be able to go sit outside in a patio and have a beer sometime. Who knows? Anything you'd like to say just to wrap up here, Akiva?
I'm good. Enjoyed it.
Okay, great. Thank you again, everyone, for joining us. Again, don't hesitate to go to info@westendwealth.com, info@westendwealth.com, if you're interested to have a chat with us and see if we can help you out or have any other question. Okay, with that, I think we're going to wrap it up 2 minutes early. Thanks again for joining us. Hopefully we'll see you next month. Bye-bye now.